Every investor asks the same questions. Where should I put my money to maximize returns or minimizing risk? Today, we're analyzing whether investing $20,000 into one of Australia's largest energy companies is a smart move in today's unpredictable global economy.
Our focus is Woodside Energy Group, a leading Australian oil and gas producer. We will evaluate its business model, recent market performance, and how global economic conditions influence its stock value before giving a clear investment recommendation.
And we're not just guessing, we're using actual data trends and global events to back it up.
Woodside Energy operates in the energy sector, specializing in liquefied natural gas, or LGN, which is a major global energy source established in 1954. The company has grown into one of Australia's largest independent producers, supplying key markets such as Japan, China, and South Korea. Its scale and long-term contracts provide relatively stable revenue streams compared to smaller energy firms.
In simple terms, Woodside sells energy to countries that depend on imports to keep their economies running. That means demand for the product is heavily tied to global energy needs, which rarely disappear, but prices can still change a lot.
Over the past 6 to 12 months, Woodside's share prices has fluctuated between approximately $22 and $32 AUD, reflecting volatility in global oil and gas prices. The company also offers dividend yields often around 5 to 6%, which is significantly higher than many ASX listed companies, making it attractive for income-focused investors.
However, this doesn't mean it's risk-free. The fluctuations are driven by external factors like the supply disruptions, demand changes, and geopolitical tensions rather than just company performances.
Key competitors include Santos Limited and global giant Chevron Corporation, both of which compete in the same LNG and oil markets, increasing competitive pressure. The energy sector is uniquely sensitive to global events, particularly geopolitical conflict. Recent tension, including the Israel-Hamas war and ongoing instability involving Iran, have created uncertainty in global oil supply chains.
When there's a conflict in major oil-producing regions, supply becomes less predictable. As a result, oil and gas prices tend to rise, and companies like Woodside can benefit from higher selling prices.
For example, during periods of heightened tension in the Middle East, global oil prices have increased by 10 to 20% in short time frames, directly boosting revenue potential for energy exporters. However, this can also introduce volatility, as prices can drop just as quickly when tensions ease.
This creates a double-edged sword, higher potential profits but also high risk for investors.
Look, I'll tell you, the Middle East situation, very, very, very complicated. But if I was in charge, oil prices, perfect, stable, beautiful. Nobody loves stability like me.
Global oil prices are influenced by supply and demand dynamics, not individual politicians like Donald Trump. In addition, broader economic conditions such as inflation and interest rates also affect investor behavior. Rising interest rates tend to reduce investment in equities overall, contributing to declines across the ASX 200, where over 190 companies recently experienced losses in a single period.
Despite this, energy stocks like Woodside have remained relatively resilient compared to the other sectors due to consistent global demand for energy.
Based on our analysis, we recommend a partial investment strategy rather than committing the full $20,000. While Woodside offers strong dividends and benefits from global energy demand, its exposure to geopolitical risk make it unsuitable as a sole investment.
A balanced approach would involve investing approximately $8,000 to $10,000 into Woodside, allowing investors to benefit from its income potential while limiting exposure to volatility.
To reduce overall portfolio risk, the remaining funds should be diversified into other sectors. For example, investing in Commonwealth Bank provides exposure to the financial sector, which is generally more stable, while BHP Group offers access to the resources sector, which perform differently under various economic conditions.
This diversification strategy spreads risk across industries, ensuring that losses in one sector can be offset by gains in another.
Our final recommendation is to invest strategically, not entirely, and to maintain a diversified portfolio to manage risk effectively.
So, overall, Woodside is a strong company with solid income potential, but it comes with risks tied to global instability.
Don't just chase profits, understand what's driving them.
In investing, disciplined decisions always dominate emotional impulses. So don't invest with your heart, invest with your head. Thank you for listening.